everybody. It's Tom Sheridan and Chris Darbyshire from 7 Investment Management, and we're here to talk about what we're doing with the portfolios for quarter 4 of 2014. Chris, we've been singing a similar song now for a few years, and you begin to ask yourself, at what point does it end? We've seen equities rise since the catastrophes of '08. We've seen the expectation of bond falls since '08, and it seems that quarter after quarter after quarter we have a similar discussion, and so we're going to give it one more try. Here we go. So what's happened over the last quarter with equities and bonds?
So it's been a quarter in which bonds really won during the quarter. We had reasonably flat equity markets, particularly from quarter to quarter, although during the quarter the paths that the different markets took were actually quite different.
Yeah, we could put a Scottish high road and low road on that one, but I guess we shouldn't go there anymore. We've done that.
No, we've done that. We're past that. Yeah. We had quite strong US macroeconomic data coming through during the quarter. We had quite a strong earnings season as well, and that helped US equities to do quite well during the quarter. They've since dropped back down a bit, some problems with Apple, and then more recently slightly weaker data.
So what I can't figure out is we have a divergence in the behavior, let's say the US and Europe, where economically the US has been doing quite well and Europe not very well. In terms of central bank activity in the United States, we see the end of QE, all the talk is about raising rates, and in Europe we have the opposite. And so we've got two completely different characters, but guess what? The equity performance is not so different.
Not so different really, point to point. Europe's path was the lower road. So Europe macro data was really very poor during the quarter, and it was saved, really the European stock market was saved by Draghi's comments in September, which gave a bit of a fillip to the market, and then the ceasefire in Ukraine. I think those two events together probably were worth a few percentage points in return for European investors.
So on a going forward basis, we still like equities?
I think we like equities more than we did in June. In June we were a bit worried about the US economy, which seemed to be slowing or at least not rebounding much from the Q1 weather problems. And we felt that that was a much bigger threat to global growth than the European economy slowing, which is somewhat expected nowadays. Because the US economy bounced back, European economy was poor, but European earnings were actually okay. So I think net, we're more positive on equities than we were in June. And of course the bond markets had a great run in the quarter, so I think we have to be less positive on those.
Now, how about the Asian picture and China in particular, and a comment on Japan as well, please?
We had a bias in the portfolios towards Asia and towards emerging markets generally during the quarter, and it worked most of the quarter very well. It's come off a bit recently with the problems in Hong Kong, and some new currency wobbles that seem to be getting into EM, but generally worked very well during the quarter. And I think we're happy with that position. What we're going to do is we're going to just rearrange the holdings within EM so that we have a bit less of the emerging markets outside Asia and more within Asia, where we think the currencies are a bit more stable. So if these wobbles continue, the portfolios will be somewhat protected.
Okay, so we have a world that is uneven in its recovery. Although equity markets seem to be a little bit more synchronized than the underlying economic activity. We're overweight equities. We're going to stay overweight equities. Let's go region by region and tell people exactly how it is that overweight equity position is getting rearranged. The UK.
So with the UK, we're, I think, very concerned about the economy, particularly the UK large cap. The larger cap has really had a very bad quarter. We've had a lot of stress in the supermarkets, for example, and the resource companies have had a tough time. And so we actually are slightly increasing our weight to UK large cap.
Okay, so an important divergence between the large cap and the small cap, and that picture carries over to Europe as well, does it not?
It does, yes. Europe, we've switched our European exposure from being pure sort of European pan-European companies to being specifically more in the banking sector.
Now that's got to be a curious move to make with all the headlines that we're seeing about the banks getting clobbered and more capital needing to be raised and lower returns in the bank. And you're going out and buying them. What are you doing that for?
So we're a bit worried about Europe macroeconomically. Still, it's been very weak. We think the banks, although they're very sensitive to the macroeconomy in Europe, a lot of the efforts, a lot of the policies of the ECB, of the European Central Bank, are going to help the banks. So we feel that the downside is a bit curtailed by central bank policy there.
So very targeted relief from Mr. Draghi and co. for the European banks, and on the back of that, increase the weighting 4%?
4%, so quite a significant switch out of the mainstream Europe into European banks.
Okay, so that's a very, very chunky move and a very decisive move yet again. So that's where we are in the UK, that's where we are in Europe. The US, we talked a little bit about already. You mentioned a shift in emphasis in emerging markets. Can I draw you out on that a little bit, please?
Yes, just simply we'll be prioritizing those countries within emerging markets that are closer to Asia, which means China, it means South Korea, Taiwan, also some of the more developed markets, Singapore, Australia. So those allocations within the emerging market position, which stays the same, those countries will be increased, and the exposure to the Brazils of the world, the Turkeys, the South Africas will be reduced.
So that's a theme that we've been talking about for almost a year now, that you can no longer call emerging markets simply emerging markets, that you're going to have to distinguish within emerging markets which ones that you really want. If I'm hearing you correctly, and the lessening of a position in the South Americans and the South Africans sounds to me like we don't love commodities a lot.
No, we absolutely don't. We'd be much happier holding importers of commodities and exporters of commodities.
And that basically is the trade weighting us toward Asia.
Correct, and I think there's one element more to it, and that is the stability of currencies in Asia is that much better.
So a reduction in currency volatility by moving away from the South Africans, South Americans to the Asians, along with the importers rather than the exporters.
Exactly, and when you're looking at the US dollar getting stronger and US rate rises, I think being more likely rather than less over the last 3 months, then that makes sense to us.
Okay, so in the developed world, we've had a large cap, small cap shift. In the emerging world, we've had a shift away from the commodity exporters to the commodity importers. Within Asia, we have another subdivision of our conversation, and that's Japan. And that's a very large position versus its neutral position for us. Talk to me about Japan, please.
Yes, so we have a triple overweight position in Japan, and it performed very well during the quarter. It was the best performing stock market for most of the time during the quarter. It's since fallen back a bit, but we're very happy with the exposure to Japan. We think what the government and the central bank are doing there is potentially really significant in a number of different levels, stock market level, cultural levels, social change really going on here. So we think it's a very exciting opportunity. So we've stayed with the equity at the triple overweight. But what we've done is we've reversed position on the currencies. So we had maintained a hedge on the Japanese yen against the pound,
Yep.
on the basis that the yen would be weaker, would continue to weaken, which it has done during the quarter. We've taken that position off now. So we're now saying that it's going to be a slightly different path going forwards for Japan. It's going to be one where it's not just about currency weakness, it's about domestic growth and Japan holding its own in the global economy without needing to weaken its currency.
So for those of you who can remember what we were talking about 12, 18 months ago, the initial stages of Abenomics were a deliberate weakening of the currency in order to help foster inflation to break that deflationary cycle. And over the last year, year and a half, we've largely seen that. And so now we're beginning to like the fundamentals a little bit better, but we're not going to hedge the currency.
That's right. We think that relationship breaks down of currency weakness and stock market strength. And also, if we're wrong, what's nice about this position is that if the Japanese stock market falls back, because it has had a good run, then the currency will protect us.
Now, we mentioned currency about 10 times in the last couple of minutes, and I think that tells you that it has become one of the most important tactical asset allocation decisions that we make at this point in the cycle, whereas the equity and the fixed income directions are a little less clear than they might have been 3 years ago. Currency takes a more dominant position.
That's absolutely right. In the last quarter, currency volatility, so the movement in currencies has really become much more significant, and that's a big change from the last few years when currencies were very, very stable.
And one of the things I would encourage all of you to do is to ask any other managers that you talk to what their view on the currency is, because I now think it takes a very, very central position in managing money. Moving quickly on to fixed income. We haven't liked it, but it continues to have done okay. And so now you like it less.
Unfortunately, the better it does, the more questions it raises in our minds about how sustainable that performance is. So we've been very underweight the risk-free part of the fixed income world, and we're now more so. We've reduced our government bond allocation to zero.
Our global government bond allocation, or gilts.
Our global government bond allocation
Right,
to
important
zero.
distinction. And that is a very important statement for us to make. And I know from listening to you over the last quarter or two that you're feeling that the fixed income market is more driven by technical factors than necessarily by fundamentals. Can you give a quick explanation of that thought to our clients?
So really we think it's about buyers and sellers. And there are some big buyers out there in the fixed income markets. China is a big buyer, particularly of US government debt. Other central banks around the world, where their economic growth models need currency stability, are really forced buyers of government bonds. And at the same time, we've had the central banks themselves, the Fed, the Bank of Japan are also buyers of their own government's bonds. So really the market is very rigged with a lot of buyers and more buyers than sellers, and I think it doesn't reflect fundamentals. So the question is, when will it reflect fundamentals? And that's timing. It's a timing that's hard to call, but I think we learnt, in 2008, better to be a year early on your call when something big like that is going to happen.
Indeed. And one of the things that we also have to keep in mind is if we're anticipating rising interest rates, and governments, developed governments in particular, have been accumulating more and more and more debt. When the service cost of that debt rises, that's going to be a very significant moment for those countries and those currencies, as well as for the bond markets. And I think you're absolutely right to position ourselves well in advance for that to happen, because when it does, it could go. We haven't talked about alternatives. Now, you've mentioned already that we don't love commodities a lot. Actually, we don't like them at all. Why is that? Is that the inflation picture that you're painting?
We think it's mainly because the supply of commodities has been very strong over the last few years as a result of big investments when commodities were booming.
Right.
That supply is still coming online, and it's still putting downward pressure on prices.
So a tempering of the growth rates in China, an increase in supply, and then superimposed upon that, you've had maybe the one-off shale position in the U.S.
Absolutely. The geopolitical situation has been actually quite stressful over the last 6 months or so, but we haven't seen commodities really go up in value, which is, I think it marks a break from the past.
It is. It's been a major difference in the way we look at the world. If only a couple of years ago we'd have had the situation in Iraq and in Syria, the situation in the Ukraine, and the threatening of European supplies, and oil prices going down, we wouldn't have believed it.
No way. So I would say that the big overweight we have in alternatives is in private equity, and particularly more in the riskier portfolios.
Right.
And we love this asset class because it is the only way you can get US corporate equity at a cheap rating. So very important, some technical reasons why we think the market misunderstands private equity, doesn't value it properly, and very keen on that asset class.
And with the level of activity we've seen in equity markets, a number of those private equity companies are now in a market where they have been able to offload some of those positions that they've been carrying.
Very good valuations.
We've talked about commodities, we've talked about private equity, and just to round out the alternative space a little bit, a quick thought on property, please.
Yes, so property, we maintain a neutral position. We quite like UK property, but find it difficult to invest, as it's a rather illiquid market.
Right.
Without that opportunity, we've fallen back on global property, where we maintain a neutral position.
And just to clarify for people, the ability to invest has to do with our UCITS structures.
That's right, and the liquidity of the market. The UK commercial property market is not particularly liquid.
And everything in the 7IM portfolios tends to be rather liquid. So there you have it. We still ride the equity theme with significant adjustments within the asset class. We continue to reduce our exposure to fixed income, and this time around it was global governments that we've reduced. We've given you the picture for the alternatives. Don't like commodities, certainly do like private equity, have a normal weight in property, and very, very importantly, currencies come to the fore in managing the portfolios these days. Thanks very much, Chris.